Overall, there is no major risk of appetite that's being seen in today's Asia session after last weekend surprising US raid on Venezuela, where the US leadership managed to capture Venezuela president. Oil price didn't actually stage a sharp rally, but instead it actually traded lower in today's Asia session, where the West Texas oil is now marginally lower by negative 0.1%. Gold price rallied by 1.7% intraday, but failed to break above a stiff intermediate resistance at around the US dollar 4,400 level. Interestingly, the US dollar managed to stage a marginal rebound as we are speaking right now, up by 0.2% as being seen on the US dollar index. Very good morning to all. I'm Kelvin here. Welcome back to today's Daily Dose of Market Insights and Happy New Year for those who have just joined us. And today will be the start of a brand new first full trading week for 2026. Today will be Monday, the 5th of January 2026. So before we kickstart the gist of today's daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so before we jump into that full suite of the latest intraday technical outlook on all those broad-based cross-asset classes that we cover on a frequent basis, let's have a quick recap what has taken shape on Friday in terms of the intraday performance of these broad-based cross-asset classes, and as well as relevant news flow / economic data release that has taken shape over the weekend and as well as in today's early Asia session. So let's start with the performance of the US stock market on last Friday. So still recall that on last Friday, for those who joined our daily dose of market insight, which I kickstarted last Friday, we still have a bullish bias on a short-term basis on all the major US stock indices, which indeed all of them managed to held above their respective pivotal support level after a test of them during the middle part of the US session on last Friday. So what you could see over here is that at the start of the US session, on my chart, we see an intraday sell-off, but this intraday sell-off managed to find some support at around 1 a.m. to 2 a.m. Singapore time on last Friday, where the SPX managed to end the session higher at 0.19%. The only laggard that is trading behind will be the Nasdaq 100, but still managed to find support on last Friday. But however, it ended the session lower at negative 0.17% over here. So like I mentioned earlier on that for the year of 2026, this will be the year of the prior laggard. That means I do not expect a very strong stellar performance in the Nasdaq 100, but however, the performance will be centered around those financial and industrial stocks that has been lagging behind in the last 2 years as the AI optimism starts to take a backseat in 2026. So that has been pretty much evidence on the trading performance of the Nasdaq 100 on last Friday, where it managed to stage a bounce during the 1 a.m. to 3 a.m. mark on last Friday during Singapore time hours, but can't manage to inch a positive gain by the end of last Friday US session, where it's trading marginally lower, negative 0.17% on last Friday. So if you look at the heat map of the S&P 500, the culprit centered on various key mega cap technology stocks that are lagging behind, which is that lagged behind on last Friday, which is Microsoft down by negative 2%, Metal down by negative 1.5%, and Amazon and Tesla down by negative 1.9% and down by negative 2.6% respectively. 4 mega cap technology stocks underperform, and that underperformance is not sufficient enough to allow the Nasdaq 100 to close in the green on last Friday, despite one of the mega cap technology stocks, which is Nvidia, managed to inch higher at 1.26%. So if you look from a sectorial perspective over here, very clearly, give me a minute, I think it's lagging. Yeah, so very clearly, we start to see outperformance in the previous laggard, where the energy, the industrial, and the basic materials managed to record a gain of 2.1% and 1.4% on last Friday, whilst the technology sector as a whole managed to only clock in 0.64%. And if you look at it from here, the Dow Jones and the Russell 2000 managed to outperform on last Friday. So that actually played out exactly with our longer team play for 2026, where we expect the laggard, the Dow Jones and the Russell 2000 to outperform the Nasdaq 100 in a very macro perspective picture, for a longer term perspective. All right, over here. Right, so the Dow Jones up 0.6% and the Russell 2000 is the best performer on last Friday, up 1.06%. All right, so another news flow will be that that Venezuela surprising we call it weekend raid by U.S. administration, and eventually the U.S. administration removed the current leadership of Venezuela, which is the president. And the reason why the removal of Venezuela president is due to the fact that right now the US has the authority to run Venezuela for a period of time before some form of stabilization set in. So given the fact that it could be another Iraq 2.0, and the reason why Trump is interested in Venezuela is due to Venezuela oil play in the world market. So given the fact that Venezuela has some of the world's largest oil reserve over here, but however, its role as a player in the global markets has significantly declined since 2015, and only right now is producing oil at a very, very low productivity level. So it's only currently produced around 1 million barrels a day, and that is only 1/3 of its 1990s peak, and currently less than 1% of the global output. And very interestingly, it's also due to some kind of a greater arc of a geopolitical team play, is the current oil supply of Venezuela goes to China as part of China's strategic reserve. So with US now taking control of Venezuela oil fields, potentially the amount of oil heading into China will be significantly reduced going forward, and that will be a bigger picture that we got to be mindful of in the longer term perspective, as this ongoing rivalry between US and China continues to play out over here. But what's interesting over here is that once US oil company is able to come in and build up proper infrastructure for Venezuela oil field, that could potentially increase oil supply going forward. So what you could see right now is the West Texas crude oil that we have a bearish bias on last Friday. It indeed move within our expectation. If you look at the West Texas crude oil prices right now, it's actually down by negative 0.24% as we are speaking, as market participants in the oil market has started to price in a potential increase in oil supply going forward. And so far, OPEC Plus meeting didn't actually create any major surprises over last Sunday over here. So given the fact that there has been being priced into the market, so for this first quarter of this year in 2026, OPEC Plus members decided to continue to pause supply increases in the first quarter as global market faces supply, and the group awaits clarity on whether the US capture of Venezuela leader Nicolas Maduro will impact supply. So right now it's more like a wait and see approach over here, and on how the new direction of the US administration, how does it want to actually administer the oil fields in Venezuela. So this has really been priced into the market, so that doesn't lead into a big surprise to the market. So market now is more focusing on the administration plans of building better infrastructure in the oil fields of Venezuela, and that could potentially see a bearish bias feedback loop being played out into the oil prices, given the fact that an improved in infrastructure of Venezuela, given of its potential strategic oil reserve underneath its soil, that could potentially increase oil supply in the global market. And given the fact that the capture of Venezuela leader Maduro, that could also remove US oil sanction coming out from Venezuela. Net overall impact will be a negative sentiment in oil market given a potential increase in oil supply coming out from Venezuela in the near future. All right, over here. And back to the US dollar. So what you could see over here is the US dollar, very interestingly, it managed to stage a bounce in today's Asia session over here. All right, so the dollar managed to inch up higher, but there is no clear dollar strength that is being seen. It seems to be trapped in a sideways range, and the dollar still remains weak against the Aussie dollar as we are speaking right now. All right, so if you look at the US dollar index over here, okay, it's trying to stage a bounce over here, and there's some interim resistance that we got to be mindful of, which is the 50-day and the 200-day moving average, where the US dollar index has been trading below it since 26th of November and 10th of December, and now it's coming to act as another round of stiff pullback resistance going forward as we are speaking, which is at 98.86 and 99.22. So despite the bounce in the US dollar right now, as we are being seen in the Asia session, so the US dollar index is up on the intraday basis 0.28%. It didn't create a negative feedback loop into the Asia stock market. So if you look at the Asia stock market, is hovering very well right now from a bullish perspective. The Nikkei 225 is up. Give me a minute. Let me see. Yeah, the Nikkei 225 is up by 2.82%, and even the Hang Seng index is up marginally, up by 0.12%, and the higher beta Hang Seng Tech index is up by 0.3%. All right, and over to Southeast Asia over here, the give me a minute, the STI index is up by 0.54%. All right, and the Australia ASX 200 is up by 0.11%. So despite the bounce in the US dollar index, it didn't create a negative feedback loop into the Asia stock market, which is trading on a positive, we call it a foothold, as we are speaking right now at 11:16 a.m. Singapore time. And even the E-mini futures on the S&P 500 and the Nasdaq 100 is trading positively as well, where the E-mini futures, I'm talking about the futures market that is trading right now in today's Asia session. The S&P 500 E-mini futures up by 0.16%, and the Nasdaq 100 is up by 0.37%, trading at a session high. So to net overall, after the outcome of what have we seen on Venezuela over the weekend and on oil prices, and that bounce up in the US dollar index right now as I'm speaking, didn't translate into a broad-based risk off sentiment, but instead right now we are seeing risk on sentiment instead, very interestingly. All right, now with that, and also let me share with you, there's one also a potentially factor that is supporting this risk on sentiment in Asia session right now, as being seen on the S&P E-mini futures, the Nasdaq E-mini futures, and those key benchmark Asia Pacific stock indices is one particular China data that came in rather rosy, kind of erasing off that deflationary fear pressure in China that managed to, that had crept back in the last 2 weeks of December last year. All right, so in today's early Asia session at around 9:45 a.m. Singapore time, we have the release of this privately compiled rating dog. Previously was Caixin, now it's called rating dog. Services PMI data from China. Okay, give me a minute, I think it's a bit slow over here. Come on, where is it? Okay, this week. Yeah, this is the one. All right, Caixin rating dog PMI. So it came in at 52, which is within expectation. So anything that is above 50, that is showing signs of an expansion in the services industry in China. So if you look at the trend over here, very quickly, so it continues to hover around that 50 level. All right, right. So the peak was in August at 52, around 53. Then thereafter, it's the growth slowed down but it stands to kind of stabilize at around the 51 and 52 level. So anything that's above 50 is showing expansion. Now it's only, we are now considering about the rate of expansion. So the rate of expansion seems to stabilize in the last 2 months of November and December. So that kind of reduce that deflationary risk spiral risk, deflationary risk spiral risk that has managed to reel its heads back up in China again during the last 2 weeks of December, where we start to see a bit of lackluster economic data on the manufacturing side. But however, the services side managed to maintain that so-called tepid momentum at around the 52 level, as being so-called released by this privately compiled agency called Rating Dog. Previously was Caixin. The China Services PMI managed to came in at 52.0 in December 2025. That is within market expectation. So that also created a bit of risk or support that ongoing risk on sentiment that's being seen on the global stock indices in today's Asia session at 11:19 a.m. Singapore time. So with that, let us now proceed to the second segment of the daily dose, which I will cover all the intraday technical outlook from the broad-based cross asset classes, ranging from FX, the global stock indices, and as well as the 2 key commodities markets, which is gold XAU/USD and West Texas crude oil. So with that, let me expand my screen. Right over here. So let's start with the FX market very quickly. All right, FX market, the euro dollar. Okay, so right now the euro dollar right now is now testing a short-term, we call it the median line of this ascending channel. Okay, let me expand my screen. Okay, sure. So this should be the better screen, right over here. Right, so this is the minor ascending channel that I drew from the low of 6th of November, connected to its higher low on 21st of November, and the upper boundary where it managed to find resistance on 16th of December and as well as 24th of December. And this is the dotted line here, which is the median line, which is the kind of, put it away, that is the median line of this ascending channel, or put it away, is the middle of this ascending channel. And if you do that Fibonacci retracement of that previous rally from the low of 21st of November all the way up to the high of 24th of December, Christmas Eve, that coincide with the 38.2% Fibonacci retracement. All right, so there's some form of support level that is being formed right now. It's testing at 116.80 over here, 1.1680, and also the hourly RSI is also back at the oversold region, where previously every time it hit the oversold region on 17th of December, previously it managed to stage a bounce. And also on Wednesday as well, the previous Wednesday, 31st of December, where it managed to stage a bounce right now. And now it's falling back to this oversold region again. And coincidentally, it hit with a support level that is rather significant, given that it's being defined by 2 different elements: a Fibonacci retracement level of 38.2% from the previous rally from 21st of November all the way up to the high of 24th of December last year, and as well as the median line of this minor ascending channel support, which I drew from the low of 5th of November, giving it as a short-term pivotal support level to watch out for today. So 116.80 will be my short-term pivotal support level. But first resistance level, in order to surpass, to escape this ongoing intraday bearish tone on the euro dollar, will be at 117.23 over here. So 117.23 is in fact today's Asia session high, and also confluence with the 20-day moving average that got broken down in today's Asia session as well. So 117.23 will be something like an upside trigger level. A clearance above 117.23 will kind of remove the overhang ongoing bearish, we call it a sentiment that is being seen in today's Asia session, as it's now trying to challenge the short-term pivotal support at 116.80. A clearance above 117.23 potentially will see the next intermediate resistance coming in at 117.65 in the first step, which was the minor swing high on last Friday, that confluence with the minor swing high of 31st of December on last Wednesday, right, at 117.65 only a clear bearish breakdown below 116.80. That is the hourly close. Below it, we'll continue to see a slight unfolding during extending into the London session today, testing out the next intermediate support level at 116.50, 116.40, which confluence with the 50-day moving average. So once it hit this 50-day moving average, I'll also be on the lookout for bullish reversal candlestick, given the fact that this is also a critical short-term support level to look out for, as well as it confluence with the 50% Fibo retracement of that previous rally from 21st of November to 24th of December, and also confluence with the rising 50-day moving average. So that's the key levels to watch out for on the euro dollar. All right, so still having a slight bullish bias on the euro dollar, but in order to increase the odds of that bullish bias, price action got to fast clear above the upside trigger level at 117.23. Next up will be the sterling pound over here. So the sterling pound is against the dollar is trading in a better shape than the euro dollar, as it still managed to hold above the rising 20-day moving average since the bullish breakout of it and the retest of it on 26th of November last year. So still no change, still having that pivotal support level with an excess on taking into account of that bullish hammer candlestick low on the hourly chart on 31st of December at the 11 p.m. mark Singapore time at that point in time, which is at 34 figure level. So having a bit of excess at the 34 figure level, 1.3430, 1.34 figure level, still having that slight bullish bias, but price action got to clear above last Friday's swing high, which we highlighted at 135 figure level. A clearance above this level will increase the odds of this bullish bias on the sterling pound for it to test the next intermediate resistance level at 135.50, 135.80. Only a bearish push down below 134 figure level and an hourly close below it will see the weakness extending further during today's London session to expose the next near-term support level at 133.65, maximum 133.25. So 133.65 is the 200-day moving average, and the 133.25 is the minor swing low area of 17th of December. So that's for the sterling pound. Onward next will be the Asia Pacific currency, which will be the Australia dollar over here. So the Aussie dollar also still managed to trade above the 20-day moving average at the 166.60 level. So still no change, still using the account 0.6660. So 66.60, 0.6660. Short-term pivotal support still remains as my pivotal support level to watch to maintain this ongoing bullish biasness that we have on the Aussie dollar, and also confluence with the rising 20-day moving average. First resistance level will be the zone that has yet to be surpassed since last Monday, which is at 67.20, 67.27. So still using this 67.20, 67.27 as my first resistance level to watch to maintain this ongoing bullish biasness on the Aussie dollar. A breakout above 67.27 will increase the chances of this ongoing bullish impulsive upward sequence, which is taken down from the low. Okay, give me, I think it's a bit slow. Can't show the previous price action. Yeah, the low of 21st of November that is still ongoing and has been reinforced by that bullish breakout on the 20-day moving average, and as well on the 50-day moving average later on the 28th of November, as it's going to oscillate within this minor ascending channel. Only a bearish breakdown and hourly close below 66.60 short-term pivotal support level will invalidate today's bullish biasness on the Aussie dollar to see a deeper minor corrective decline unfolding to test the next support level at 66.30. A breakdown below 66.30 will see an extension of this minor corrective decline sequence, exposing the next near-term support level at 66 figure, 65.90, which is the minor swing low of 18th of December, and also correspond very closely to the rising 50-day moving average at 65.90. All right, so that's for the Aussie dollar. Lastly will be the dollar yen. So the dollar yen continues to push up over here at this upper boundary of our neutrality range so far. So what we could see is the hourly RSI has started to shape a higher high. All right, a higher high and a higher low above the 50 level mark, and price action now is breaking above the upper boundary of this neutrality range that we highlighted earlier on last Friday over here. So this turns to be in green. Okay, move it. So with that, I got to respect this ongoing short-term bullish tone that is being seen on the hourly chart of the dollar yen, where price action is breaking up above this 157.15 level, 157.20 level, and with the hourly RSI showing a series of higher high and higher low above the 50 level mark, indicating some form of short-term bullish momentum on the intraday basis for the dollar yen. So with that, I will have a rather tight short-term pivotal support level for today, which is this minor swing low that has been tested on last Friday US session, can't break below the low of last Friday Asia session at 156.56. Right, so this will be my pivotal support level. One, 5, 6. Okay, give me a minute. Let me put it in writing. Okay, seems to be a bit slow. Okay, I'm able to right now. 156.56. Pivot. Okay, so as long as this short-term intraday pivotal support at 156.56 holds on the dollar yen, potentially it may see a further squeeze up to retest this range top that has been in place since 20th of November 2025, previously at 157.88, where previously it got rejected very closely on 19th of December. Okay, they'll be at 157.88. Only a bearish breakdown below 156.56 will invalidate this intraday short-term push-up scenario for the dollar yen, for it to slide down and revisit 155.90 again, which is the minor swing low of 29th of December and 30th of December that confluence very closely to the 20-day moving average. A breakdown below 155.90 will see further potential weakness for it to drift down towards the lower limit of this complex sideways range configuration that has been evolving, which is also confluence with the 50-day moving average at 155.35/155 figure level. Right, so that's for the dollar yen. Flipping to a short-term intraday bullish bias due to an improving hourly RSI momentum indicator, using 156.56 as my short-term pivotal support level, but resistance level that I'm going to watch out for today will be only its range top in the first step at 157.88 that has been in place since 20th of November 2025. So that's for the dollar yen. All right, so that sum up the 4 major US dollar intraday technical outlook. Let's now proceed with the major stock indices, starting with the Hong Kong 33 that's representing the Hang Seng Index. So the Hong Kong 33 burst up as expected, hit our second resistance level at 26,405 that we highlighted on Friday, before doing a pullback as we are seeing right now. And this pullback also takes shape after it hit the overbought level on the hourly RSI. So right now, potentially there could be some form of retracement taking shape on the intraday basis as the hourly RSI starts to work up from its overbought level after hitting it on Friday during the US session. So all you could see right now is a potential, it has really seen a minor bullish double bottom over here by this 2 green box that I highlighted from the low of 21st of November and on 16th of December on the hourly chart. And the neckline resistance, it got taken out during the Asia session on last Friday. And the pullback of this neckline resistance now turns into a critical pullback support level in order to maintain this minor double bottom bullish breakout is at 26,106, 25,984. All right, over here. Let's push it up so that you guys could see clear. And that also confluence with the former minor swing high of 29th of December and 12th of December. All right, so using this 26,107/25,984 25,905 short-term adjusted short-term pivotal support for today on the Hong Kong 33 that is representing the Hang Seng Index. I will still maintain that bullish bias, but bear in mind that you may see another 1 or 2 hour more of dip before a bullish reversal starts to take shape as its hourly RSIs try to work out from the previous overbought region where he has already exited from it in today's on last Friday US session. So using 27,107, 25,984 as my key pivotal support zone, adjusted one. As long as this pivotal support zone holds, we will still maintain that bullish intraday short-term outlook on the Hong Kong 33, with the first resistance coming in today's Asia session high over here at 26,500 level to round it up. Okay, 26,500 level. Above 26,500 level, potentially sees the next resistance coming in at 26,670, which is also confluence very closely to the 1.236 Fibo extension of this ongoing minor uptrend move from the low of 16th of December, and also that's also the minor swing high of 14th of November 2025. Only a bearish breakdown below 25,984 will invalidate the bullish bias on the Hong Kong 33, representing the Hang Seng Index, to see it floating downwards lower to retest the minor swing low area of 30th of December and 31st of December at 25,545 next. So that's the Hang Seng Index. Next up will be the Japan 225, which is representing the Nikkei 225. So the Japan 225 managed to shape that expected bullish breakout from the former minor swing high area of 4th of December to 12th of December, and even that stubborn former range high of 4th of November to 13th of November. Okay, so this will be my pullback support level to watch at around the 51,500 level. So using this minor range top of 4th of December to 12th of December, and as well as a confluence with today's Asia session low at 5,718. So it's a zone. So using a Titan pivotal support zone for today at 50,985, 50,718 on the Japan 225, that is representing the Nikkei 225. Still maintain that bullish bias for an intraday perspective. Next resistance level to watch will be at 52,136 over here, which is the minor congestion area of 31st of December. A breakout above 52,136, potentially seeking out a fresh all-time high at 52,775, 53,045, which is the Fibo extension cluster level. Only a bearish breakdown below 50,000. Okay, before that, let me expand this screen so that you guys could see clearly, much more clear. A breakdown below 50,718 over here. This lower limit of this short-term pivotal support zone will negate today's direct bullish bias scenario on the Japan 225 to see a pause for another round of minor corrective decline back to retest 50,180 / 49,850, which confluence with the 20-day and the 50-day moving average for 50,180. And upon hitting this level, I do expect the Japan 225 to stage another recovery again, given that its medium-term outlook still remains on a bullish perspective. So that's for the Japan 225. Next up will be the Germany 30, representing the German DAX. So the Germany 30 continues to trade within this bullish uptrend channel that has been in place since the low of 21st of November. And with that, price action managed to hit our first resistance that we highlighted on last Friday, which is at 24,655. So given that it hasn't cleared above 24,670 level, we will still have a pivotal support level at 24,430, which is the former minor swing high of 29th of December. At 12th December, clearly taken out on last Wednesday, now turns into a critical near-term pullback support level. 24,430 short-term pivotal support level on the Germany 30 still maintain its bullish biasness. a clearance above this 24,670 in today's European session, then from there onwards, I could tidy up the pivotal support level to a higher level, taking into account of last Friday minor swing low area during the US session at 24,525. All right, so until then, we'll still maintain our short-term pivotal support level at 24,430. Next resistance level to watch after 24,670 will be 24,795, 24,830, which is a Fibo extension level over here, and above 24,830, which is the 24,836, pardon me, and also confluence with the current all-time high at 24,795. Potentially, we will see the continuation of the bullish impulsive upmove sequence to seek out a higher resistance level defined by the 0.764 Fibo extension level of this ongoing minor bullish uptrend phase that has been in place since 24th of November at 25,065, and that also confluence with the upper limit of this ongoing bullish ascending channel as well. Only a bearish breakdown below 24,430 that would invalidate or negate today's bullish bias tone on the Germany 30 to see another round of choppy minor corrective decline to retest the 24,235/24,120 level, which confluence with the lower limit of this minor ascending channel and the rising 20-day moving average. So that's for the Germany 30. Next up will be the major US stock indices. Very quickly will be the Dow Jones Industrial Average. So the Dow Jones Industrial Average staged a bullish reversal right exactly at our predefined support level that we highlighted on last Friday at 48,100. That will be the intermediate support, and the pivotal support will be at 47,870 over here. And also the hourly RSI continues to shape a higher low. Correct, over here. So no change given the fact that it hasn't cleared above our first resistance, but it almost hit on last Friday at 48,480. I'll be still using the pivotal support level at 47,870 to maintain that ongoing bullish biasness for the US Wall Street 30 that is representing the Dow Jones Industrial Average. A breakout above 4,480 on hourly close above it, potentially seek out the current all-time high area at 48,770 for the 8,870 in the first step. Only a bearish breakdown below 47,870 will negate today's bullish bias to see another round of choppy minor corrective decline to retest the minor swing low area of 10th of December at 47,530, which also corresponds very closely to the rising 50-day moving average. So that's for the US Wall Street 30, still maintaining that bullish bias. Onward next will be the SPX 500. So the SPX 500 also managed to bounce off from our support zone that we highlighted, 6,850 first support zone, pivotal support at 6,822, which confluence with the rising 50-day moving average. And where the price action bounced, it bounced off from this ascending channel support. Come on, what is it? Okay, yeah, this ascending channel support drawn from the low of 21st of November, right? So with that, still maintain that bullish biasness using 6,822 as my short-term pivotal support level. First resistance level to watch will be 6,925, followed by the current all-time high intraday high at 6,953 on the SPX 500. Only a bearish breakdown below 6,822 will negate the bullish biasness to see another choppy corrective decline, retesting the minor swing low of 19th of December, acting as the next intermediate support level at 6,780. So that's for the SPX. Next up will be the Nasdaq 100. So the Nasdaq 100 play around with our pivotal support level before staging a bounce in the later part of the US session on last Friday. But so far, where it bounced, it managed to bounce off from this parallel ascending channel support, also drawn off from the low of 21st of November 2025. So having a bit of excess over here. All right, so a little bit of excess. Okay, at around this 25,133. All right, 25,133. 25,133. So 25,195 excess 25,133 still maintain that bullish bias on the Nasdaq 100. So first resistance level to watch will be that rejection level on last Friday at 25,600, and this level has been a stiff resistance since 30th of December, and it got rejected again on last Friday, 2nd of January. So a clearance above 25,700 will increase the odds of another round of bullish impulsive upmove sequence unfolding on the Nasdaq 100. So in the first step, retesting that's minor swing high area or that range resistance that has been in place since 8th of December at 25,760 / 25,830, and it has still some more way to go before hitting the fresh all-time high that was printed previously on the 30th of October at 26,290. Right, so the Nasdaq 100 currently right now is the laggard, okay, among the major US stock indices. Only a bearish breakdown below the excess pivotal support at 25,133 that would negate the bullish biasness for the Nasdaq 100 to see another choppy corrective decline sequence extending further to expose the next near-term support zone at 25,000 / 24,870 next. So that's for the Nasdaq 100. Lastly will be the commodities asset classes, starting with gold XAU / USD. So for gold on last Friday, we do have a bullish bias. So the bullish bias hit our resistance zone at 4,403. 4,430, and in terms of a Fibo retracement, taking into account of the fresh all-time high that was being made on the 26th of December at 4,560 level, and if you do the retracement all the way down to last Wednesday, 31st of December low, that also confluence almost with the golden ratio at 0.618%. And given the fact that we start to see from the Elliott wave perspective, we see a 5-wave down, 1, 2, 3, 4, 5, and this is a kind of an ABC corrective rally. So after this ABC corrective rally, potentially we may see another slide coming down to retest the lower boundary of this ongoing minor ascending channel drawn from the low of 28th of October 2025. So from a Elliott wave and Fibo analysis perspective, whatever rally that we see from last Wednesday and in today's Asia session, it's more of a minor counter trend rebound scenario, and this minor counter trend rebound scenario is coming very close to the tail end, which is the 0.618 Fibo retracement, maximum 0.764 Fibo retracement. That also take into account of the congestion area that's being formed previously on the 23rd of December and 24th of December at 4,485. So using 4,485 as my short-term pivotal resistance level to fit the strength, I will flip to a bearish bias for today, given that the minor counter trend rebound scenario may have really reached its terminal, we call it a terminal level at 4,403, 4,430, maximum 4,485. So as long as 4,485 short-term pivotal resistance is not surpassed to the upside, I will flip to a intraday bearish bias right now on gold XAU / USD. So first support level to watch will be the gap up that is being seen in today's Asia session at 4,033. So it's a zone, 4,033, come on, 4,333 / 309. All right, so 309 was last Friday swing low on the US session. Okay, so it's a zone over here. So this will be the first support zone to watch. A breakdown below 4,309 will expose further weakness towards 4,267, 4,243 in the first step, which is the lower boundary of that minor ascending channel and the former minor swing high area and the congestion area of 1st of December and 12th of December. Only a bullish breakout above 4,485 will invalidate this bearish bias view to see a retest towards the all-time high area at 4,550, 4,560. So that's for gold XAU / USD. Lastly will be the West Texas crude oil. So the West Texas crude oil on last Friday, we do have a bearish bias. Bearish bias hit our first support level at 56.80, which is so the minor swing low area of 26th of December before staging a bounce up during the US sessions. And in today's Asia session, it got rejected again, close to the 20-day moving average at 57.98 and formed a bearish shooting star candlestick at the 9 a.m. Singapore time hour mark. So prices can't break below the 56.80, so I do not want to tighten my pivotal support so tight to 57.98. So I'll be still using a pivotal resistance zone on similar to last Friday, which was also the 50-day moving average at 58.76, 59.18 on West Texas crude oil to maintain that bearish bias. Only a clear hourly close bearish breakdown below 56.80 during the European session, then I will tighten my pivotal support to 57.98, which is the 20-day moving average. A breakdown below 56.80 exposes 55.75 and 55.23, which is the critical low of 16th of December. Only a bullish breakout above 59.18 will invalidate the bearish bias on West Texas crude oil to see a squeeze up towards the $60 psychological level, maximum 60.56, which is the minor swing high area of 5th of December. So still maintaining that bearish bias outlook intraday basis on the West Texas oil. So we have covered all the intraday technical outlook on the broad-based cross asset classes. So right now, let us take a quick look at the economic calendar. What are the key data to look out for in today's Asia session over here? So in today's Asia session, will be rather quiet, and when we stretch out into the European session, not much key data to take note of, unless not much key data to take note of. And the action will come at 11 p.m. Singapore time today, where we start to see the ISM manufacturing PMI data for US, where market participants is expecting almost a contractionary situation in the manufacturing sector for US, coming in at 48.3. That's expectation, slightly below 48.2 that was printed in the previous month of November. So any data that is coming within expectation of 48.3 and even lower, that could potentially keep the US Federal Reserve on an interest rate cut cycle. So far, if you look at the CME Fed Watch 2, market participants is not expecting a fourth cut to take shape on the next meeting on 28th of December, because a market participant is assigning a high odds that it will stamp at 3.5% to 3.75%, 82% chance. But the fourth interest rate cut will start to come in on the 18th of March. So that will be the second meeting of 2026. So a rather high chance of 62%. The market participant is expecting the Fed to cut again on 18th of March to bring the Fed funds rate lower to 3.25% to 3.5%. So this calculus may change if we start to see a rather weak ISM manufacturing PMI data that may start that turns up much weaker than 48.3 that was market expecting. Let's say coming at 47 or 46, the odds will start to increase as well, and perhaps we may start to see an increase in chances for the fourth cut to come in on the 28th of January 2025 if we start to see a rather weak ISM manufacturing data out later at 11 p.m. today. So the net overall impact is that market is still looking for the Fed to continue its interest rate cut cycle into 2026. So for now, market participants is assigning at least 2 interest rate cut in 2026, one coming in as early as 18th of March, followed by the 29th of January 2026 FOMC meeting, also a high chance of 61%, to bring the Fed funds rate lower at 3% to 3.25%. So net overall impact on the US stock market is added liquidity into the US stock market, which is still positive, and also with the Fed still ongoing its interest rate cut cycle versus other central banks like the RBA potentially pausing its interest rate cut cycle and even attempting to be much more hawkish in 2026, and with the ECB and the Bank of England clearly stating that they are coming to the tail end or even ended their interest rate cut cycle that has taken shape last 2 years ago, that could potentially see the dollar continues to weaken going forward. All right, so with that ends today's Daily Dose of Market Insight, a slightly longer session, given that I have much more ground to explain, given that also what has taken shape over the weekend, and also this is currently the start of a full trading week for the first week of 2026. So with that, I'm Kelvin here signing off, and we shall speak again tomorrow. Thank you.